Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders are discussed, tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. NeedToFillStockBroker.com, PSW, nor its affiliates, or any of their respective officers, personnel, representatives, agents, or independent contractors, or in such capacities, licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you risks and potential rewards of trading options. We are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold you above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Wow, okay. So where are we, kids? What's going on? Futures, nope, wrong one. Chart. There they are. Another wonderful day. We're busting up to incredible new levels. It's unbelievable. I had to bail on the NASDAQ finally. I gave up on my shorts. They were just hopeless. Look at this. I mean, when it broke over 7,600, I bailed. That was losing another $9,000. So I'm about $27,000 down there. That was over 76. I should have bailed with a $3,000 loss at 7,500. Wait, was it 7,500? Seems like so long ago. Oh my God. Yeah, when they crossed 75, I was supposed to get out, but I wasn't home, and it went up to 75.50. I said, okay, let's wait and see what happens. Then it went to 70. Then the kid just kept going up, and it was just like out of control. I thought at some point it would pull back, and it never did. So now, as I said in chat, instead I picked up the SQQs, because here's what you can do instead. Because you can't just keep shorting the futures when they're out of control. There's no limit to your losses, so it's ridiculous. That's me like 10 years ago. Oh, it's so cute. All right, let's see. That. Oh. So back right just here before we started. See, Dave has been doing NQ2. Just totally sucks. It's so annoying when something goes that badly against you. What did I say about SQQ? I forgot. Oh, all right. So I wrote here, I'm down 25,000 on NQ, so my revenge trade is going to be 50 SQQ November 10, 13 bull call spreads at 155.60, so that's net 95, and that pays $15,000 at 13. So they're at 11, so it's already 5,000 in the money, and you can buy it for 47.50. So there's really no premium on that. You're actually getting a discount when you pull into it. So I'd rather have that. Even if the NASDAQ blasts up, I'm not going to lose it all right away. I'll lose half, but I won't lose it all. And I'd rather have a measured loss there, because as you see how quickly it was, I lost another 9,000 on the stupid futures, you know, when you get a pop like we're getting today. So it's not worth staying in, not that level where I am. And realistically, that's another thing. It's a big problem people have. When you lose money, don't try to get it all back. Try to get back half. You know, if you get back half, then you lost a quarter of your money instead of losing half your money on a trade, right? So you get back to 75%, you're like, okay, I can manage this. You can work your way out of a 25% loss. trying to get back to even from 50% down in one shot is not a good idea because you're risking too much. So, let's say I had let's say I started with $100,000 that I was willing to trade on this play, and I lost $25,000, right? So I got 75,000 left. Well, if I want to make 25,000 back, I would have to risk probably another 20. I would have to, if I wanted to make 25,000 back, I'd have to risk. I can tell you exactly. I'd have to do 2.5 times this, because this will make 11. This will make 10,000 back, a little bit more than 10,000 back. So if I want to make 25,000 back, I would have to put in 2.5. I'd have to put 10,000 down as a risk to make 25,000 back. And I don't want to keep risking that much. I don't want to risk another 15, another 10, another this. That's not worth it. So small steps. Instead of putting 12,500 down to try to get my 25 back, I'm just going to try to get half back, because now if I lose 5,000, I still have $70,000 sitting around that I can play with. I'm going to allocate it to the NASDAQ trade, to the NASDAQ short trade. So that's where I am on that. That's my block on NASDAQ is getting chewed up. And now my RB trade is getting chewed up. Look at that. As soon as I went in, it blasted up. Wow. 204. I got to add. See, now I got to add one here because it's flying higher. I came in at 1195. I got to add another one here short, so I'm going to. So let it settle down first is the question. See, oh, wow, that was that was annoying. So here's where I entered, and now while I'm talking to you, it blasted up to here. I don't think I should probably go. I don't think I should get more right now. I'm gonna get one more. So there's one at 20035. So now my average is 1998. So I got my average right where I wanted, right at 2 is my average now. So that's okay. So I'll take that. And I'm down $600 now because I entered below the line at 05 because I was impatient. If I was patient, I could have entered everything at 2 and not have a loss right now. But this isn't a now trade. This is a trade that's going to last me through the holidays. So we'll just see what happens. Oil, if oil blasts up to 60, which I don't think it will, though. I don't think it does. I mean, 70. It doesn't look like it's gonna. Then maybe we'll have something else to trade. But right now, I don't see what's going to go on. Now let's see. 3 says, Phil, you will hate me for this. Oh my gosh! But you have done me good, and I want to give you honest feedback, color on what I'm seeing in my small hillbilly rural manufacturing town. Today, School Line. I'm not sure what that means. Today's School Line, everyone was looking to go into the market, counting on S&P 500 crossing 3,000. Oh, I see. So she's saying that basically in the school, in the line, I guess she means in the line at school, that everybody's oh yeah. So 3 saying that that basically everybody in the town, like the school line or whatever, was basically saying that everyone's talking about the market. We're in one of those markets where it's a bubble and people are just piling in and everybody feels like they're missing out. That's why it's not a good idea really to do heavy shorting. I'm shorting because I don't want to. Mostly I'm shorting because after losing 25,000 on the NASDAQ and giving up on the short, I'm going to kill myself if it goes now. If it drops tomorrow, I'd be so pissed. So I have to have something in play. Even if it's only to make me back to 10,000, at least I have something in play. I'd rather lose 5,000 and not miss a short than miss a short. You know what I mean? And 3 continues. It seems to me they just got over skepticism, and today they don't have convictions. Don't have an agenda. Try to give you color. I appreciate that. That's good. That's good input. Tom says your time on the NQ exit was excellent. I was amazed at the 50-point run that went right after. Yeah. Thank God. Look, as I said, I should have given up at 25. If I hadn't given up at 25, I would have a $3,000 loss. If I had gotten out at 25, I would have only had a $3,000 loss. The rest of my loss came from not getting out at $25,000, 25, about 25,000, whatever it is, 2,500. And you've got to have that discipline. It was my fault. I was away from the computer. I'd gone out to dinner after hours, and the thing popped on me, and that was it. I was screwed. And as I say, you really can't walk away from these kind of trades, and you can't ignore the futures unless you have a lot of money to burn. You know, and look, while I can deal with the loss, here it was, right? So, what actually happened? It was here, yeah, right here. See, this was Friday night or into Sunday. I know what it was. It was Sunday night. That's what it was. So Sunday night, I went out to dinner. I was down $3,000 here, and I was like, okay, fine. So I left it on the weekend. I said, well, we'll see what happens. So Sunday, I went out to dinner instead of watching the market at the open. And by the time I got back from dinner, it was already up here. You know, it was up around here at 75.30, which isn't that terrible. So I said, well, you know, let's wait and see what happens at the opens. This is bullshit future stuff. So then in the morning, I'm doing my post and not paying attention, and it went all the way up to here. While I'm writing my morning post or just after the thing opened in the morning. So again, I'm just like, oh frick. And I'm like, well, that can't last. And then that's it. Then it came up. Yesterday it hit 7,600, but it bounced back. So I was a little heartened by that. And but today was the last straw, and I just said, the hell with it, I can't take it, because that's just horrific. And but again, had I been disciplined and gotten out when it crossed the first new level that it hadn't crossed before, I mean, frankly, I shouldn't have even played it when it was up here. But I shorted, and I shorted at 75 because I thought it was going to get rejected. It got mildly rejected, came back. I didn't get out of the position, which I should have, and then it went bonkers against me. Had I followed the rules that I keep banging the table on all the time, I would not have really lost anything on this trade. So it's entirely my fault. It's just bad trading. And I'm very, that's just all I did. It's just very, very bad trading. I should have got stopped out when I said we should stop out. And then here, well, that's too late already. But even here, it's like I didn't go against myself twice, because that'd be ridiculous. Meanwhile, the DAX is holding 12.5. That's a bit bullish. If he goes over 35, that's going to be bullish. Let's take a longer view on the Euro stocks. So if they get back over 35, they're going to challenge 36 and then possibly start breaking up. Once these guys get going, everything's going to start. Then you got a global rally. 13,000 is new highs for the DAX, basically. You start going up from there. So if everybody starts breaking out, this thing's going to get huge, and all the people on Sri's lunch line are going to get very excited. whatever it is you're doing over there. Phil, if you were to bet on S&P 500 crossing on options, what's that mean? Phil, if you were to bet on the S&P 500 crossing on options, crossing what is the question? You're saying 3,000? I think 3 means if they cross 3,000. because finding it too hard to ignore the fever around me, a small bearable loss gamble. Well, as I said yesterday, looking at things to be bullish on. Where's yesterday? Looking at things to be bullish on, to me, Germany is lagging by quite a lot. So we don't have a dissimilar economy. They don't have the trade issues that we're having right now. The EWG was a very easy bet yesterday, and it still hasn't moved very much. Where was that? Was that Monday? Must have been Monday. Okay. I do look for these things, but just because everybody's talking about the S&P, you got to use your head and say, well, that's a little bit heavily traveled road, so maybe you want to look somewhere else. So, first of all, Brexit. Oh, Nasdaq 8100 on the composite. Holy shit! There it goes. Incredible. Whoops, EWG. There it is. So it's a very simple spread. EWG is at, I don't know what it's at. It'd be good if I knew these things. EWG is at 31 now. It was at, this is, we did the play on Monday when it was at 30.50. And we were talking about buying 20 of the October 29s for 170, selling 20 of the 31s for 60, so you're paying $1.10, and also selling, in this case, LB, because I like the LB puts, but you can sell anything you want as far as an offset. But in this case, the net of the trade was $80, and it's a $4,000 spread that is, well, actually now it's 100% in the money. I don't know what the prices are now, but now it's 100% in the money. So, I mean, it's not hard to make money if it's a bull market and you want to bet on it being a runaway continual bull market. Wow, it's hard to make money short in gasoline, though. Look at that. I should have waited. And there's 69.50 on oil, but, you know, we're going to have to wait for it to stop before we start making any real bets. But, you know, when you're in a bull market, everything works. It's like in 1999 saying, well, what .com should I bet on? I'm like, whatever one comes out tomorrow. You know, whatever goes public is just bet on and it's going to double. That's China was doing that for a while too. China's market, when it was bubbling up, anything you bet on, any IPO would double the next day. We weren't far off back in 2007 with things that were going IPO. I think anything that merged or IPO would go flying higher. There doesn't have to be any rationale to it, because those last people who come in, the people who come off the lunch line and start buying, they're not discriminate. They just pay whatever the price is. They say, oh, I got to get in on this Google thing. So how much your shares? $1,300, $1,500. Oh, wow, that's a lot. Okay, here's $1,500. That's what they cost. There's no thought process for the people, for the retailers that start coming in, where they say, oh, that's too much for that company. They don't even know what they're buying. Do you think they really understand they're buying 1 millionth of Google? They don't even understand what the purpose of these options are, the stocks are, or what they're actually doing. Nor do they understand the business of the company, other than they heard of them. That's what you call dumb money. I mean, these people are just buying whatever for whatever. And if you want to be a rational investor, you can go jump in and join them. But I like at least to use a modicum of intelligence and say, well, you know, this SPY may be toppy, but if it's not, then EWG is too cheap. That's a pretty logical conclusion that I can draw, because I can look at these things on the futures chart here. Not that. Where the hell did it go? There. I can look at the indexes in the futures, and I can see that the DAX, which is EWG basically, is way the frick down here, and so are the Euro stocks. But I don't want the Euro stocks because I don't like all the Euro stocks. I don't like every country in Europe. I do like Germany. There's nothing wrong with Germany. And if Trump settles with Canada, he settles with Mexico, if he ends up settling with Germany, the auto companies will come back, the DAX will fly up, whatever. I don't care. This is an $80 trade that pays $4,000. So I can make that kind of money betting on something realistic like that, instead of betting the S&P is going to go to 3,000. It might go to 3,000, but do you think it's more likely the S&P goes to 3,000 or the DAX goes up, or the DAX holds this line here while the S&P is going to 3,000? It's the same bet. It's possible that the DAX will diverge from the S&P and go the other way, but it's not that likely. You know, the Euro thing, the whole Brexit thing that was hurting Germany in the first place is not really there. Europe's calming down a bit, and again, everyone's got to catch up to America. If we're going to go crazy like this, everyone else has got to somehow catch up. And these markets are flying. Holy crap. And as we said, people, you know, this is the you know, these are people at, you know, they come into the market and what do? They buy SPY. They're not even buying specific stocks, they're buying SPY. And that means that every single stock in the S&P, whether it's a piece of crap or not, gets bought along based on not whether they're a good company or not based on their performance, not based on their earnings, just based on the fact that they're in the S&P 500 and whatever market cap valuation they have will then be added to by the money that comes in from these people who are buying the index funds. That's what I was talking about. Was it today or yesterday? I don't remember. I think today. I don't know what I'm talking about. Oh, wait, go away. Let's roll my indexes today. I think it was. Yeah. Yeah, it's ETFs. I mean, look at this. Here we are in 2007, before the crash, and we were just getting to about $500 million of ETF money. That's not a big deal. That's not a big thing. But since 2016, we went from 1.5 to 2.700. So in other words, $750 billion went in 2017. No, I'm sorry, during the year of 2016. Now we're up over 3 billion now. We're another $750 billion when we're up over 3 trillion on ETFs now. This is last year. This money is pouring in at an alarming rate. A lot of it is because people are switching to them. ETFs lowered their fees generally, and that put a lot more financial guys started recommending them to their people. Individual stocks are wonky, while the indexes seem to march up in a pretty consistent manner. So again, people who are trying to mitigate their risk are drifting into these ETFs, especially SPY and things like that. It's obviously ETFs, if you have like my kid's a college account, all you can do is pick ETFs. That's why I got out of it. That's why I cashed in. All you can do is pick ETFs. You can't buy individual stocks in a college account. And a lot of people's work accounts are only ETFs, also the IRAs, the 401ks, things like that. If that's all you can buy, that's what you buy now. The more, when you hire more people, you create more people who buy ETFs, right? So there's you know, employment causes this. More jobs makes this happen. We have a very ETF focused economy now, and this is how they go up. So money pours into the ETFs. If we get a calculator, where's the calculator? All right, so let's say that 10 million more people got jobs, and they make, let's say they make $40,000. All right, so that's 10 times. No, wait, I'm gonna do that with things. It's messing myself up. 10 times 40,000. Don't mix your thingies. Yeah, that's $400 billion per year. And so let's say that people put away just 5% of that. So times 0.05. That's still $20 billion a year going into of extra money pouring into these retirement accounts just from regular people having jobs. Then you've got the housing bubble burst, and the money didn't really go back into it. Do we have a housing thing? Oh, where do we have that? Briefing? Yeah. Well, that's good, but it's the wrong calendar. Economic. I'm trying to find a housing one. Case-Shiller home prices. No shit. Wait, it's not really what I want, though. Nope, not that. What do you think? Construction spending? Not really. Building permits? New home sales. There we go. Here you go. Okay, so although housing is recovering, it's mostly recovering in dollar terms. It's not really recovering in sales terms. Back in the housing boom, 02, 03, money went out of the market, right? Crash back in 2000. Money went out of the stock market into the housing market, drove housing prices really, really high. People weren't investing in stocks, they were investing in houses. Then, boom, the housing market crashed. And now people are not investing in houses the way they used to. Imagine what this gap is. Here, well, let's not imagine. Let's say 600, and let's say normal would be a million. Let's not say normal. That's not a normal housing market. Let's say normally there'd be a million new home sales a year, which makes sense. There's 100 million homes in America. So just to keep up with population growth, you really have to sell a million homes a year, not to mention not all homes last 100 years. So certainly a million homes a year should be being constructed. But they're not, and they haven't been in a long time. So what's bad for the builders, though, means somebody is getting that money that used to get spent on housing. So where are we? We're down at 600 here, so we said 400. So we're talking about 400,000 homes times, let's say, $300,000. There's another $120 billion a year. And where does it go? Whoops, not there. Where did I put my ETF chart? Here. Another $120 billion a year. So you have $20 billion from people working, you have $120 billion that people aren't spending on houses and putting into that instead. You have people aren't buying treasuries because they don't pay any interest, so all the people who used to buy treasuries are doing that. And don't forget, the people who don't buy treasuries doesn't hurt treasuries because the Fed buys all the treasuries people don't buy. So that's what keeps, usually there's checks and balances. Usually if everybody didn't buy treasuries, the rates would go up and that would cause different problems. But we don't have that problem because the Fed is buying all the notes that nobody wants. And it's a Fed that has a $4.5 trillion balance sheet, that's keeping this bubble going. That doesn't mean you bet against it, though, because it's like, to get a bubble, imagine like a kid's bouncy castle thing, right? The natural state of the bouncy castle is to be a flat piece of, a big flat thing of plastic that lays on the floor. But when you get one of those air blowing machines, right, it blows it up and it's all inflated and people can bounce on it and have fun, right? How long can you have fun on it? Until it pops from too much bouncing, or until somebody turns off the air machine, in which case the thing goes back to its natural state. So the Fed is like the big air blowing machine. It's not stopping. They're still buying a tremendous amount of bonds every month. That's still stimulating the economy. See, when the Fed says they're removing their accommodation or whatever, they didn't stop putting the money in. What they did is, instead of increasing the amount of borrowing that they're doing, instead of increasing the amount of money they're putting into the economy, they're just rolling over the debt that's retiring. So in other words, when $60 billion worth of notes matures that they bought 10 years ago or whatever, when those mature, they then take that 60 billion and buy the next round of notes. So they're maintaining their asset base. But the net effect of that is the Fed's still out there buying the treasury bills. You can call it what you want, but they're still writing a check for $60 billion a month. They're not, because what they're not doing is they're not reaping the benefit of the cash coming in, because the Fed is not an investment house. They're not a hedge fund. That's not their job to do that. But on the other hand, they technically borrow the money on behalf of us, the taxpayers. And if the Fed takes a loss, it goes in the Treasury's balance sheet. If the Fed has a gain, it goes in the Treasury's balance sheet. But they have a weird way of accounting for losses, because since the Fed doesn't really have expenses, right, other than paying off some governors, whatever they pay them, zero compared to obviously the trillions of dollars they work with. So the Fed considers it a profit that they get interest, even if it's 1% interest on $4 trillion, which is a lot of money. It's is it $45 billion, or it can't be 450? 45. 4,500 billion times 0.01. 45. So the Fed gets 45 billion in interest, or whatever they get in interest, right? They consider that a profit. So how does the Fed can't really, it's hard for the Fed to lose money. They have to buy an asset that depreciates over time. And since they keep buying the notes, they don't depreciate over time. They don't take a loss on them. They keep the notes flying. So it's a weird sort of thing where they claim to have a profit, even though obviously they didn't keep up with inflation, and they're giving that money that's worth less. Yet even though the $45 billion they're going to give back in profit to the Treasury this year from the Fed, even though that money was worth much more 10 years ago, and even though the $4.5 trillion that they borrowed from the people, that that was our money, even though that money could have been put to much better use in a billion other ways, it doesn't matter. They're going to be thrilled with their 1% little profit that they made. It's an opportunity cost of money. They're not fixing infrastructure. They're not educating our children. They're not paying down the national debt, which we pay more money on. Nobody, and that doesn't count. That's just an expense. That's somebody else's problem. The debt, the national debt's another problem that doesn't matter. All they're saying is like, well, we have 4.5 trillion and we're using it to make 1%, 2% interest. That's what we're doing with that money. So you should be really thrilled with the way we're handling things. It's idiotic. But anyway, that's how you artificially keep the rates down, which keeps people from putting money in the bank and keeps people from putting money into treasuries. And now if you're not putting money in the bank and you're not putting money in treasuries and you're not putting money in housing and commodities are wonky, what the hell's left? You have to put your money into SPY. And just before we started the webinar today, I printed a very appropriate cartoon or a thing here. The most important table in personal finance. $1,000 after 25 years, if you invest it at 8%, accounting for 3% inflation costs, you end up with $3,300. In other words, you'll have a lot more than that. At 8% gains, $1,000 over 25 years, you're gonna have a huge amount of money. But when you take inflation into account, you have you've gained $3,300 real dollars of buying power. If you put $1,000 in the bank, though, at 2% interest, after 25 years of 3% inflation, you lost 25% of your money. That's obvious, right? Your buying power is 778 on the same money. If you put it in cash, you've lost half your money. If you spend it, obviously you have zero. You have to always make these choices. And then Bart down here is saying beating inflation is the only way to increase your wealth, which is, I thought that was good. You can't just try to increase your wealth a little bit, because that's what people are realizing. That's what these lunch line people are realizing, is you can't just a little bit beat the money, beat the market. You can't just a little bit beat inflation. You'll be treading water. You're not going anywhere. So people are forced, and you don't have to be an economist to understand this stuff, because people understand it because they make the same money. Unfortunately, nobody gets raises anymore. They're making basically the same money they made in 2010. Only now they can't buy as much stuff. They know that. You don't have to explain it to them. They got the same job, they're making the same money, they live in the same house, only they don't have any money left to spend. Everything's getting eaten up. There's nothing to save and nothing to spend. So those people know they've got to do something. And then they hear about this market that's making these 1% a day gains. And they say, wow, I need that. That's how I need to make money. So they put money in the late stages of a bubble. That's where money comes from. It comes from all the people who think they missed out on the bubble. And they start putting money in. And you got to be really careful about that mentality, and you got to be really careful about chasing those numbers because, you know, in Holland, in the 1600s, they had a tulip bubble. It was a 1400. I don't know, some ridiculous. It was anyway ridiculous. 1600 seems too modern. There was a tulip. But here, I tell you, I mean, why guess when we have Google, right? We talked about the home sales, so we don't need that chart anymore. Holland tulip mania. See, it's a well-known thing. Here you go. 16th. Okay, it was. So in 1634, for some reason, tulips go into fashion. And they go from 1 to 2 the next year, to 4, to 6, to 10, to 13, 30. They didn't bother stopping at 30. They just go straight from 13, from 15 to 60 or whatever it is. And then right after that, not even one, not even where they started. Tulips, it's not a metaphor, it's tulips. People were buying and hoarding and storing. I'm sorry, that's stupid, isn't it? Anyway, that's what happened. This chart is showing like in a close-up that it actually hit 200 at some point. But whatever, it doesn't matter, concept's the same. In 3 years, people went bonkers over nothing. Over like, literally to this day, people like, what the frick was going on? It's a goddamn flower. It obviously isn't worth that much. But that's what you say about all the .com companies now, right? You say they never were worth it. Yet here we are worshiping Amazon and worshiping Netflix and worshiping whoever the hell is in there, Apple, Google, Facebook. You know, and again, it doesn't mean all the stocks are bubbles. Apple is a bargain. Apple has $250 billion in cash and makes $50 billion a year. That's not overpriced at $1 trillion. $1 trillion is only 20 times what they earn, not counting the cash and not counting the growth. That's a good stock. That's a stock I'd pay $1 trillion for. Amazon doesn't make that kind of money, yet they're valued. Morgan Stanley just today said they're worth $1.2 trillion. And how do they come up with those numbers? They justify it by saying that Amazon's self-driving car stuff is going to be a $200 billion addition to their value. Well, that's interesting because the same company says Tesla is going to be worth $200 billion based on their self-driving cars. So suddenly everybody's self-driving cars are worth more than the entire auto market is today. It's odd, it makes no sense, but you know, what the hell? It's an easy story to sell people because they don't do the math and they don't sit down and think about these things. Okay? I mean, look, all right. First of all, I mean, what nobody's really taking into account, okay, yeah, Toyota. Okay, this is a car company. Market share wise, Toyota market share. All right, Toyota has, no, what's a global market share? That's 4% of Europe. Toyota, there you go. No, that's in Japan. Come on, man. Audi, Toyota. I really feel like it's more than 10%. I think it might be Toyota. top by market value. That's not helpful, but it also part of my point. Anyway, why can you know? There you go. Global manufacturer market. Look at yeah, Toyota. There you go. Freaking giant. That's a terrible chart, but anyway, yeah, that's what I thought. So they're 17% there between. Point being, that's what you call a car company. And where did we just say they were for worth or something? We were looking at something. There you go, market value. I don't know if this is right. Let's take a look over here. I'm sorry, I'm a big factor. Like if I see something, I don't believe it until I check it. So it's like I don't like to like start looking at something if I don't know where they're. All right, 184, close enough. Okay, so it's close enough. And it does say two, so probably it's like written last year or something. So here's Toyota. I don't know where that number comes from. $172 billion. Dahmer 78, Tesla 60. And is Tesla still 60 or is this, how old is this? That's one I think is Tesla. No, they're still around 60. All right, that sounds right. I'm going to say that's correct, especially now they sold off a little. Might be below. 52. All right, there you go. Now they sold off. So these are pretty accurate. Ford 43. This is ridiculous. What was they saying? Self-driving cars, right? Okay, so the entire auto market, not I mean I know there's other people, but who cares? 100, 200, 300 joke. We'll count them, I guess. So that's 300 and another 125, 400, 500. So $500 billion is the entire auto market of the planet Earth. All right, $500 billion. We call it $600 billion if you add in like some of the bigger cars. Although like BMW is there is BMW, so it's not like Mercedes is left out. They're part of Daimler Chrysler. So there aren't that many people being left out. Porsche is left out. A few guys are left out. No, Porsche is Volkswagen. It doesn't leave much out. So basically, it's a $500 billion market, and that's giving Tesla the benefit of the doubt. So that's market cap, of course, but market cap is not sales. They don't sell that much. I'm just talking market cap. So the Morgan Stanley analyst says Amazon's non-existent self-driving cars are going to add $200 billion to their market cap. But they say that about Google too. And they say that about that's the excuse for valuing Tesla at that price. That's the excuse for and do you think that Chrysler and Toyota and BMW are all going to roll over and say, oh, we're giving up our car market to Google and to Amazon? So that's number one. Number two, obviously, if one succeeds, the other's going to fail. We're not going to physically start being in cars twice as much. And in fact, if you think about it, what's going to actually happen if there are self-driving cars? If there are self-driving cars, there won't be any parked cars, right? Why would a self-driving? Okay, if you think about it if you think about the current model, you're like, oh, I'm going to sit in my self-driving car. I'm going to get in my self-driving car in the garage, and I'm going to have it drive me to the store, and it's going to go park itself in the parking lot, and I'm going to wait. And then when I'm ready to walk out of the store, it's going to come and pick me up and take me home. So it's basically your chauffeur. And that makes sense to a person who's not looking to save any money. But that only really accounts for us. Like we're in the people in the top 10, 20%. We'd be willing to have a car that's so cool that it does everything, so out of bid and call all day long, right? Not everyone else, not the other $400 billion worth of the market. If self-driving cars, if you don't need a driver in an Uber, then 1/3 of the cost of the Uber is out. And as it is now, I will tell you that my children are they both take Uber instead of driving, and so do many of their friends. They don't have cars. The trend for the younger people is not to have a car at all. And if there's more self-driving cars, it'll be easier and cheaper to get a car. I mean, if you think about all the cars think about your car. Is your car usually being used, or is it usually not being used? And you think about that and apply it to every car in the world. And all that unused auto time can be shared and create a much lower cost for the cars. And if you're sharing the car, you're not likely to get the luxury cars either. So this whole model is going to be upended, yes, but not to add value to the whole pie. It's going to deplete value. But what's going on in the S&P is that you've got these idiotic analysts. They don't take away value from Toyota. They don't say down the road Toyota is going to be worth less money or Daimler is going to be worth less money. They add the value to Google, and they add the value to Amazon, and they add the value to Tesla. And so they double the projected amount of auto revenues for the entire planet Earth into the forward market valuations. Out of thin air, they create entire new planet Earth worth of market for self-driving cars without saying, well, if they're self-driving cars, then there's no regular driving cars. If Amazon's selling $200 billion worth of self-driving cars, where's Google? Where's Toyota's $200 billion worth of cars? Are they going to be self-driving too? If they're going to be self-driving too, sure, they could be, but it doesn't mean that now we're going to have $1 trillion worth of self-driving cars instead of 500 billion. It makes no sense. So, yeah, probably Amazon will get some market share, Google will get some market share, and that means that the big guys will probably lose some market share overall. But I think the whole thing is going to really pretty much collapse, because what's going to happen, if you go to cities in Europe where they have good public transportation, we don't have that in America. But if you go to places where they have good public transportation, people don't buy cars. Even my friends in New York, they don't own cars. When they need a car, they rent a car. Why would they buy a car and pay for the insurance and blah, blah, blah? What's the point? It's the same thing my kids realize. My older daughter did more of a cost-benefit analysis of the thing, and she goes, well, if I get a car, I got to get a job just to pay for the car. It makes no sense. Even if I kick in on the insurance, I said to her, I'll pay the insurance, but I'm not paying for your car. I said, you got to get a job. And frankly, I would have probably given her a car, but that's beside the point. I would have given her a car, but she still would have had to take care of it and everything. It's still money. Just the maintenance and so on and so forth, and gas and so on. I said, I'm not going to sit there and subsidize your entire car. So she takes Uber. She spends, I'd say, no more than, even in a busy month, not even $200 taking Uber wherever she feels like it. Because most of the trips are $8, $10, $15, and she doesn't do it every day. Sometimes her friends pay their Uber. Sometimes she pays her Uber. It seems to work out fine for everybody. So, her car bill is negligible. Nobody's going to dump that. And it's sort of like the horse and buggy. It's like nobody, when the cars replaced horses and buggies, none of the horse and buggy manufacturers thought it was going to last, and they didn't think they were going to lose their market share. I'm sure there'll be some cars, but everybody's going to still go for a horse. Why did you give up a horse? Get reliable, solid transportation. A horse is your friend. A car is not your friend. It didn't last long for them either. There's so many changes happening in the market. I mean, it's like electric vehicles and all that stuff. But if you think about it, if you could, and you can't, but if you could transport cars across the continents along with the sun, you wouldn't need 1/3 of the cars on Earth, because mostly cars are in the garage, right? You're at work, you're in the work, you don't need your car. You're sleeping, you don't need the car. So 2/3 of the time, you don't need your car at all. And if you were able, if the earth was one continuous strip and you could drive the cars to where they're needed, and like a fleet would just leave and go where they're needed, you would hardly need any cars on the entire planet. They would just go where people need them. And as the sun moves around the earth, the fleet of cars, of self-driving cars, would just run around with it. We're not going to have that kind of motility, but you're going to have, you're going to have all these cars, and all these people are going to realize it doesn't make any sense to have a car that sits there 2/3 of the day doing nothing. As it is now, I step out my door at my place in Delray. I step out the door, and they've got many choices of transportation. Nobody in this town has a car in Delray. This is in Florida. It's a beachy town with like a lot of stores and shops. They've got a trolley that goes up and down the street, the main drag. They've got golf carts that come around and take you for free. Just tip the driver. They just come around for free and pick you up. And you can call them. You can pick them up like an Uber. You can hit them on your app, but they only stay in the general 1 mile area of the town. And then of course you've got Uber. If you want to go crazy and get out of town, you can take an Uber wherever you want to go. And if you want to go further, if you want to go to any of the surrounding towns, there's this super fast train they got here. And that's like $10. Versus it costs $7 to park on the freaking street. The $7 an hour. Sorry, not $7. So $7 an hour, or not $7. Sorry, valet parking is $7. So whatever time you want, I guess. But valet parking is generally $7 in town. So most people don't bother having cars. What's the point? Then you're gonna park it. You're gonna leave it. It gets super hot in the sun. So you can either go start your car, which is super hot, sitting outside somewhere, or you can have an air-conditioned guy come up, pull up in the car, you get in, you get out, when you're done, he goes away, you get another one on the way home. That's what self-driving cars are. Nobody's going to buy self-driving cars and put it in their garage, not regular human beings. Rich people, yeah, people who trade stocks, yeah. And that's the problem, because the analysts and us, people like us who are buying and trading stocks, we all say, oh yeah, sure, of course I'm gonna have my own self-driving car. And I probably will, because for me, I want a certain kind of self-driving car, and I want a better quality TV in the car that I'm gonna watch. I want a really nice couch. I want to have a refrigerator filled with my stuff. I would like my own self-driving car with all my cool stuff in it. But I can afford to make those choices. So when I think of a self-driving car, I think of this really cool custom little room that I get to be schlepped around in, which is not different than having a nice car that you like with all the stuff you want. But not everybody, most people buy functional cars. The majority of cars that people buy are functional cars, not fancy cars with a lot of stuff in it. So it's going to be the same dichotomy of the audience, the same split in the audience is going to exist, where you're going to have the rich people who can get their cool luxury self-driving cars, and I don't want anybody else in my self-driving car with all my stuff in it. But regular people are going to be very happy to be picked up by an NTC, taken where they want to go, dropped off, and they don't have to think about it again. But meanwhile, $500 billion gets added to the theoretical forward valuations of companies like Google and Amazon and Apple and whoever the hell else feels like saying they're going to have a car in the future. These analysts are perfectly happy to ascribe the entire auto market. I mean, the idiocy of what the Morgan Stanley guy said, which is, where is it? Let's see if we have that. I mean, these guys really piss me off. It's not just that it's sloppy, it's dangerously wrong. Waymo, oh, I'm sorry, 175 to Waymo. He didn't specifically say it was Amazon that's going to do that. Subscriptions, blah, 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 blah. Okay. So for Google, it's Waymo. $175 billion for Waymo. So Google He's giving this value now to Google. For their self-driving cars, he's adding $80 a share, or $60 a share. And he thinks he's saying that's just 25% of where they're going. But he's giving them $45 billion now, even though they have zero sales. He's going to give them, he says they're going to go $175 billion. They're going to have 40% of the entire global auto market, is what he's saying. So clearly, Brian Novak is a moron. Yet he's the Morgan Stanley analyst, and he's the reason the NASDAQ shot up today, because Brian Novak, it's his job today to put it's his job today to goose the market. That's his job. His job is to pump the NASDAQ is at a critical juncture. It either could have pulled back or it could have gone higher. And they sent out Brian Novak to just make up some completely nonsense and peddle it to the public and jack up the price of these things. And this is the bullshit he came up with. For Google, it was Waymo, and for Amazon, he says he likes the web services. Obviously, we like the web services, but again, it can't grow forever. Advertising, subscriptions, blah, blah, blah. He likes Amazon, whatever. It's really not really saying anything special about it. But for Google, he came up with a reason, and his reason was idiotic. And again, the concept of throwing out these numbers on trillion-dollar companies, 1.2 trillion. He added $200 billion to Amazon. I got confused. He did. He added $200 billion to Amazon. Actually, more than 200 billion, because to 2,500. I mean, for God's sake, he's adding. I don't think Amazon's like 1.8. Amazon's like 850 now. So he's adding $300 billion to Amazon's market cap. Just throws it out there. Sure, yeah, they're worth another 300 billion. Google, yeah, they're worth another couple $100 billion too. So that's the power of being a Morgan Stanley analyst. You can throw $500 billion out into the ring on two companies, and people actually believe you and follow you in. And that's the kind of bullshit people are investing in right now. It's complete nonsense, but nobody stops to think about it. Nobody's critical of these things. And, Alphabet's not worth $1,500 a share, and Amazon's not worth $2,500 a share, but you know what? All it takes is for one guy to buy one share for $2,500, and the whole company, if it's the last trade of the day, the whole company jumps to $1.2 trillion. Now, you try liquidating it, and you'll be lucky to get $500 billion, but nobody's going to, as long as you don't try liquidating it, no one will find out. And that's how these markets go. They'll last until you run out of suckers who are willing to be the guy who buys with the close. What's going on here? Why does it seem like, I don't think you guys can see these questions, so let's see. Trying to catch up. Okay. Robin says, Phil, I only have a tentative grasp of rolling SQQ. How do you avoid losing the entire value of the short call? All right, the short answer to that is that, first of all, you don't just buy. Losing the value on the short call, you're saying the wrong thing, because the short call is the thing you sold and you want them to lose value. But let's talk about the spread. So if we start with an SQQ play, and again, always keep in mind this is insurance. So right now, it's September, and let's say we want to buy insurance through January in SQQQ. SQQ is at 11. It's a 2 times ultra, so if the S&P drops 10%, then this will go up 30% to 14. If the S&P drops 20%, this will go up 60% to like 17. So now we know the target we're looking at. Unfortunately, SQQ doesn't have that many strikes. Not these. This is March. March has a lot more strikes. I don't know why January doesn't have many strikes. So you know what? I wouldn't even take January because I want March. I want more strikes. Our target then, step one, you don't want to hedge against a 5% market correction. That's silly, right? In other words, you buy medical insurance, but you don't buy medical insurance in case you scrape your knee. You know, you're like, well, if I scrape my knee, I'll put a Band-Aid on it and I'll fix it. You don't run to the doctor to fix scraping your knee. You don't want insurance to overcover you because you don't necessarily need that much coverage. You buy flood insurance, you're not buying flood insurance for every time it rains, they're going to pay for your Bounty paper towels, and it would cost a lot more money because you're overcovering. You can get your own damn Bounty towels and mop up your own floor, you know, if it gets wet. Insurance is for catastrophic losses. So 5%, even 10%, it just makes your portfolio go down a bit. If you're in a huge bull market and you've already made 20 or 30%, that money is your insurance. Your profits are your insurance also. So realistically, what you want to do though is you don't want to lose more than 10%. So 10%, like we said on the S&P, will take you to 14. 20% will take you to 17. So we don't want to go crazy. We don't have to hedge like deep in the money. We can hedge right where we are now, even the 12. And you can pick up the 12s for 145 of March of 19. And you can sell the 15s for $1 or maybe 90, whatever. So that's what I say, the 12s? Yeah. So the 12s, remember we said it's going to go to 17? So let's say you did the 11s. No, the 12s. I'll get the 12s. So let's say 145 and 95, just for argument's sake. So it's 50 cents on a 12-15 spread, on a $3 spread that's out of the money. So you can get 6 times your money back if the S&P drops 20%. If the S&P drops 10%, you'll get probably your money back. But you won't. You're not mitigating a 10. You know, you're not mitigating a 10% drop in the S&P, but you are mitigating a 20% drop in the S&P. So it's good catastrophic insurance that pays 6 to 1. So keep in mind your net though on the trade is only about 50 cents. Your net 50 cents in on a $3 spread. Now, let's say that it's now the front month. And the $11 calls, and then we had the was it the 12? Sorry, the 12/15s. So the 12s are down. Well, let's say it's still a month out. You see how the 12s are 50 cents in October? You're still 50 days away. So right now, March is 200 days away. 3/4 of the time from now, or at some point in between, doesn't matter when really, when the calls go down to 50 cents. The 15s you sold is still 15 cents or 20 cents, but these are down to 50 cents. That's the same 50 cents you paid for them. So the move you make then is you cash those out, and you figure like 15 is kind of unrealistically out of the money. You're not going to leave it alone, but what you're going to do is you're going to take your 50 cents, the same 50 cents you put into the trade, and you're going to take it, and then you're going to buy the March spread to cover. And now the March spread, which is an it's a 12/15 spread, is now covering these short 15 puts. These short 15 calls. So now you have a brand new spread with a much longer time frame, new insurance. You didn't spend any additional money, and maybe you want to put a stop on at least half of these at 25 cents. So your worst case scenario is you'll end up putting another 25 cents in, but the only reason you'd be doing that is if they start running up in price, and that would mean your spread would go more in the money. But the key takeaway, not to, I'm saying a lot of what ifs, if that, but the key takeaway is that when the value of your calls, your long calls, drops to the net that you paid for the spread. In other words, you paid 50 cents for the spread, but your calls were 140 at the time. So when they drop down to 45, you say, I want to grab that value. So you cash them in, but then you've got to cover the short, but that's okay because it's insurance. You always want to be covered. So you're going to cash in what you did spend and reuse that money for a longer spread, and so on and so on. You just keep doing that. But it's very important that you keep a good stop on the things. If you're leaving making short calls, you want to keep a good stop on them. You know, or you could buy half back right away, or you can buy them all back right away. And all it does is all it does is mean that you spent a little bit of money, you spent half the cost of the spread to buy it back. But it's insurance, and again, it pays 6 to 1. So if it pays 6 to 1 and you only lose half, then you're getting 12 to 1 back on the amount of risk you're taking. That's good insurance. That means you can insure. You can put 10% of you can put 5% of your portfolio into the insurance, and it'll pay you back 30% if there's a 20% drop in the S&P. 30% of your whole portfolio. And all you're going to lose if you have to roll it out later is 2.5% at worst. That's how you manage it, but you've got to understand the mechanism and keep practicing at what you're doing. But you know, just every month, just ask in chat, and we'll talk about like the adjustments. But the key is to roll when you know, like we just did, in fact, which might have been a little bit premature, but we just rolled out our SQQs because, well, I mean, frankly, with the time frame we had, by going to a longer time frame, we mitigated the damage. And in fact, the short positions that we left open are getting chewed up by the movement that's now happening in the NASDAQ and everything else. So hopefully it's working out for us. I'm not sure. So he said, if it helps, the smartest person in my town sold the Russell 2000 and buy more SPY. I just don't see it. I think that things are being super overvalued. I'm not gonna. I certainly don't want to buy any of these indexes at these prices. I mean, there's perfectly good stocks that I like to buy that are still cheap. So why should I buy the expensive stocks too? COV8 is approaching 70. You like it short of that level or wait? I mean, look, for the purpose of this thing today, I like it short of that level, but realistically, I don't want to jump too fast into it, especially if I already have my RBs. Oh, nobody told me that happened. Look, I have a profit. So I'm going to go back to 2, because that's what I wanted. What am I buying? I forgot what I'm doing. What am I short? I'm short, so I'm buying. So now I'm back to 2 short at my price, 1995. Yay! So now I'm exactly where I want it to be. That's what I mean by scaling in, right? I took an entry here at 1995. It went over, and I averaged myself up to about 199, and then it shot up, and I ignored it because I said, well, look, if it's going to go much higher, I'm going to wait because I get more of a pop if I start adding here. I'm going to get a better average than if I start adding here. So I got to wait and see what happens. Oil, same thing though. I feel like oil's going to go down. I'm doing an and or, so I'm like happy to short gasoline. This is not 100% sure thing, although it's been incredibly reliable. but I don't want to overdo it. As you saw, just like money just goes up and down really fast in this thing. So if oil does go to 70, I would short them, but since I was already in gasoline, I wasn't really looking to short oil. I would have started at 69.75, frankly, same thing. Same thing I did here. I started 1995, so I didn't want to miss it. And over here, I would have started here. And somebody obviously did, because it turned on a dime, 69.75, but it never went higher in that case. And don't forget, the real story is in the gasoline, because it's gasoline that people were supposed to be using over the holidays. Frankly, the oil is already being used. They already refined the oil. They already sold it to the gas stations. That the real draw would come on the gasoline if there's a lot of vacation travel. But again, we go back to the new car thing. All the new cars get better mileage than the old cars, which means even if people make the same drive on vacation that they made before, they're going to end up with using less gas. Oh, look at that, $275. Very nice. Okay. So, so that's how easy it is to make money doing this stuff. I wasn't even paying attention. If you do it right, if you do it wrong, you lose a fortune like I did on my freaking NQs, although those are pulling back now too. But we'll see. I'm sick of the indexes. I don't even want to look at those. Oh, I'm sorry. Is this not CLV8? I'm pretty sure it is. The front month should be CLV now. Yeah, it is. That's what CL is. RB is not the front month. If you do just an RB, you're going to get the old contract still, unless they changed it. But I don't think they did. Nope, see, still up at 210. So it's a V8. You got to be careful because sometimes they roll them and sometimes they don't. And we care about the RB V8. And don't forget, by the way, I'm not expecting I wasn't expecting to make money today. The point is, it usually gasoline goes up into the holiday weekend, which includes Friday. It could be 202 on Fridays, right? That's why I want to get back to 2 contracts. Whatever it peaks out at, or if I feel we're getting a good peak into the weekend, I'll add a couple more and average myself up. But I don't want to miss if $2 ends up being the top. So I just want to have a couple of contracts just in case. But you know, Friday is when I get more gung-ho, like it's like, okay, fine, this is everybody's bet for the holiday weekend. And they can keep having this fantasy of all this demand until Wednesday when we get the actual facts in the EIA report. And then we'll know what's really happening. 3 said, no clue what that means. I don't know if you mean about the Russell or whatever. All I know is he's rich and successful like you. Well, look, look, people make decisions for whatever reasons. I'm telling you my reasoning on why I don't believe in it, because you have idiots like this Morgan Stanley analyst just throwing $500 billion of value out as if it's real. He just made up a $500 billion. I wish I had that kind of power that I could make up a $500 billion and idiots are going to follow me into it. It's like, hey, oh no, you know what? Give another $500 billion value. That's good. Just those 2 companies there. $500 billion. Sure, I'm going to just write I write 3 freaking paragraphs on that and make the $500 billion. It's just so ridiculous. But people take it seriously. It should be a joke. He should be ridiculed in the town square. But it never happens. It's so weird. Sri says, personally, for my money, except for this one gamble on S&P crossing, I can't wait for you to start bear put spreads. Oh, yeah. I mean, it's too scary to short. We don't have a lot of shorts on the market. We don't have a lot of shorts on stocks because everything freaking goes up and up and up. And where we are now, we're a long way from even getting a technical breakdown. I'm starting to look at stocks to put together a shorting list of stocks that I think are really overvalued, but you know, it doesn't matter if people are buying the ETFs and they buy the bad stocks with the good stocks. It doesn't matter how bad a stock is; it's still going to go up. Please consider TTM, Phil. They are the Toyota of India. Oh, Tata Motors also own Jaguar and Land Rover. I think it's fine with them. But again, it's like it's hard to say. There's a lot of Tata's business I don't know about, so I don't play them. Okay, even Toyota, I kind of, when they're really cheap, I don't mind putting my foot in, but I don't know what's going on in Japan. I don't know what's going on in the rest of the world as far as that. When I look at Chrysler and I look at GM, I look at Chrysler, I look at GM, I look at Ford. They're heavily dependent on the U.S. market, and or less so Chrysler, of course, but because of Mercedes. But still, there's enough U.S. focus there where I can say I got a pretty good handle on how many cars they're selling, what's going on, so on and so forth. It's a whole nother level of looking for stuff and figuring things out and finding charts. If I try to get good numbers out of like India to figure out what Tata is really doing and what their distribution lines are like and what kind of profit margins they're making. And by the way, when you get into those kind of companies up there, Toyota too, the currency conversion issues that they have are staggering, because they sell most of their cars outside of their home country. That's crazy. That means you're so dependent on international exchange rates and such, and also trade shit like, you know, we got one wacko like Trump, and it throws off everything. So, you know, Tata's a great company. It's amazing, but you know, as far as me investing in them, it's too much to track, really. I mean, that's why I don't tend to play them. Please, Phil, can you walk us through what happened on rollover, say RBU8 on September 18th? Well, what do you mean what happened? I think you're probably looking at this chart. Energy RB hours. Is that what you're looking at? What are you saying? What on rollover on September 18th? I don't know what that means, September 18th, because you're talking last year. Oh, anyway, I can only guess you mean this rollover. Nothing happened. This contract is not the same as that contract. So this contract is for gasoline that's going to be delivered during the month of September. This contract is gasoline to be delivered in October. So an intelligent trader knows that there's not going to be a lot of demand in October. There might be demand in September because of the holiday weekend. There might be a demand spike. Since by the time the stations have to refill their tanks, it'll be already the first week of September. There might be a nice draw in gasoline, and that will make the gasoline these people are having delivered more valuable. So they're betting there's going to be a little bit of a bump into the holiday. But that doesn't affect October at all. Nobody goes anywhere for Columbus Day. You know, it's not much of a holiday. You know, I don't have any Columbus Day plans. I don't know about you guys. So there's not a big effect. Now, if this one, again, you can't see this contract anymore. These contracts went in lockstep, basically. What you see here, though, both contracts were declining. They bottomed out here, and now they're both going back up, and this one's back up here at 210. But they're just moving together. There's no difference. They're just different contracts, and there's 10 cents less value to the October contract. The rollover, the chart doesn't make it clear that it's not the same contract anymore. That's the problem with these charts. It would be nice if they labeled them or something, because it looks kind of weird when they gap out like that. But that's all it is. There's nothing else is on it. I guess you'll see the same thing in WTI. Oh, well, I don't know for sure. I mean, they might have rolled their contract here. Who knows what their rules are, frankly. But you know, you say all you can do is do the best you can. I mean, when it lines up, I like to always check to see if it's lining up properly, because otherwise you have no idea what's going on. Three says, say if I had a position in RBU8 short at 212 and it did nothing and it's 202. Well, if they're going to pay you for 10 cents, then you should be freaking thrilled and you should take the money, because it's bullshit. That's not right. You had it short at 212. I didn't even know RBU8 went to 212. And it did nothing, and it's 202. I don't understand what you mean by that, but I mean, look, if you made 10 cents, take the freaking money and run. What else do you want? Broker closes it out at the market close and charges a difference. Well, if you're short and it went down, it wouldn't matter. And that's really not how it works. You're making a hypothetical. That's not how it goes. Your contract, if you leave it until expiration day, they're probably going to force it closed, because I don't think they want you to. They would have to, on your behalf, take possession of thousands of barrels of oil, and they would have to chase you down to make it whole. So, you know, obviously they're going to force you to close. close your position. If they forced it closed, it's closed. End of story. And you're gonna but it's whatever that contract moved. They're not gonna hit you. Believe me, you would know it. If you suddenly got billed for 10 cents, that's $4,500 per. No, I'm sorry, it's 1,000. I'm sorry, it's 10,000. 10 cents would be $10,000 per contract. So you believe me, if that was the case, you would certainly know they did it to you. So that's what happens. Okay, so if you have the U8 contract on the last day of trading, they're going to shut it down and you're going to get whatever you got on it. End of story. You would have to then go and open a V8 contract. They're not going to do that for you. I don't think any broker is going to automatically roll it. And you'd have to make the decision in your account to say, I want to buy this one now instead, or short this one now instead. So, you know, we shorted last week. We shorted one of them. We shorted U8 recently, and then I think it was 2 weeks ago we shorted U8. Then last week we said it wasn't the right time, and now today it is the time that we wanted to do it. And now we're just kind of hoping oil goes as high as possible before we short again. But meanwhile, we're up $300 on these contracts. And then here we're up 69.50. It's just I'd rather wait and see what happens. It could go higher tomorrow and Friday, so I don't want to jump in and go too crazy on these things. All right, so what else should we talk about? So how's the indexes looking overall? Everybody pulling back? Oh yeah, 25 points. Well, not much of a pullback there. I don't feel bad. How did SQQ get there? It's funny. So Brent's obviously Brent topped out at 77.52. Natural gas made a little bottom and come back. Gold is hanging out at 12.10. Silver 14.70. That's tempting down there. Copper I wouldn't touch. Coffee's coming back to a good price. Now 99 was the bottom, but figure $1, you'd be lucky. So 101, I'd start buying coffee again. No, I'm sorry, 101. Yeah, maybe 102. I don't know. I would go long 101 and then add a 100. I'm sorry, 102. I would go long 102. I would double down at 101, sorry, and I would get 2 more. So I'd go 4 long, and my average would be below 101 if I did that sequence. So I'm comfortable with that because, again, I think there's no reason it wouldn't go back up to 105 easily. At which point I would scale back, just like on the gasoline. I would scale back 2 contracts at a better price at a good entry, and I'm happy. And then let it go. You know, and especially, again, this is also a good lesson for you, for those of you who can benefit from my suffering. I lost $25,000 on those freaking NQ contracts, okay? I need to make that back. So I said I took the NQ short, I took the SQQ play. That's $10,000 if all goes well. And meanwhile, though, I make 1,000 here, I make 1,000 there, and every day I try to make a little bit of money and get my money back. And then once it's back, then I can start making big plays again. But while I'm wounded, I'm not going to make big plays. I'm going to make little controlled small plays that are going to just incrementally get my money back. Then when I have the money back, then I can start making some big swings again. But I got hit. And there's a limit to how much. I mean, I could lose more money. It wouldn't kill me, but I don't like to. I'm there, and I don't try to get even immediately. I just say, okay, so now I got to put my nose to the grindstone, and I got to come up with 20 different ways to make $1,000. And that's how I make that money back. You know, and you guys see how I trade. It's like I trade in big blocks. I often make 5,000, 10,000, whatever. It's not like, you know, the losses are dropping the bucket in the year's profit, but it's still freaking $25,000. I'm just angry about it, and I want to get it back. I don't like to have that kind of a loss in my column. And it doesn't really get it back. It's still a loss, but at least I know I made that money back. So, you know, opportunity-wise, though, I'm probably going to end up wasting the entire month. It'll take me 2 weeks, 3 weeks to make that money back. So what does it really net out? It nets out to zero, but not really, because it means that had I not lost that money, and again, I lost it by stupidity, I lost it by not following my own rules. And had I not lost that money, I'd be up in 20,000. I'd be up $40,000, or I mean, if I would have made the normal $20,000 I would make, plus the 20,000 I now need to make it back, that's a $40,000 swing. So that's bad. And that's why we have those rules, and that's why you have to stop out when you're losing money. Take the small loss because you can get it right back. When you take a big loss, you can't get it right back by taking another big risk. That's the road to damnation when you do that. You have to stick to your plan, and the way to stick to your plan is to do what I just did. I took one contract on RB, it went up, I took one more, it went up, I took one more. As soon as it got even, I got back out. Now I'm going to watch and wait and see what happens. Not jumping right back into the big RB short, even though frankly, I think that's one of the easiest shorts you can make. Shorting RB into the holiday, had I not lost on NQ, I would have 10 RB shorts right now. Not yet, but I mean by Friday, I would be short RB. I would be heavily short RB into the weekend, because it's one of those. It's like a gift that keeps on giving. Usually, I feel way better about that than I do about NQ. But you can't make up a loss by taking another big risk, because God forbid you lose the second big risk, then you've got a huge loss. Then you have to make a huge risk to make that up, and then you get another huge loss, and before you know it, you're homeless. So that's not the way to play. So that is not what I wanted to talk about. I just got sidetracked checking it. Let's see. Oh, well, let's talk about portfolio balancing. It's a good thing to talk about. So here's the long-term portfolio. When did we do the last review? Oh, yeah, okay. So on August 2nd, and it wasn't, I'm sorry, it wasn't August. August 2nd is when I did the review. So I don't know what the actual date of the LTP review was. It was, oh, here you go. I see, right? I don't know if you can see that, but if I mouse over it, it's 7/20. So it was actually July 20th. So it was more than a month ago. We were at 634,000, up 26.9%. We got ripped off, which should be another 8,000 once we get the credit. Huh. All right. So on July 20th, we were at 634,000, and now we're at 720. So up basically 100,000. Now it's a $500,000 portfolio. That's 20% in one freaking month. That is completely ridiculous. What do the months look like? Here's July 28. Only S&P only went up 100 points, which is just not even 5%, 4% of the S&P. And we went up 20%. That's, you know, while it sounds great, it's also kind of scary. But this is what happens. Every stock just goes up and up and up. And we did get aggressive on some of these positions. Now, in the short-term portfolio, though, we didn't lose money, because you would think we would lose money because we have hedges in here. And maybe it's up and down, whatever, it doesn't matter. But 120, you know, up 220 is up 120%. That's because in addition to the hedges, we also do things like, here's the short puts, and you don't think it's a lot. It's only 6 short puts, but those 6 short puts were $10,000, $15,000, $20,000, $25,000+ just of short put sales. Then we've got a long spread on Apple. Then we've got IQ, which has been a huge winner for us also. We have Tesla, which we shorted. There was a short that we actually played out. That made some money for us. I mean, it's it's 10,000, 5,000 here, 5,000 there, 25,000 there. That's where it adds up. And these are all short-term plays that we've gotten out of. So all year long, we've been doing those to offset the hedges. And then they don't have to be short. There's no rule. The short-term portfolio is for taking advantage of short-term opportunities. That we think something's going to happen soon. It's going to drop a bunch of money in our portfolio. So we'll take that bet. Now, in Celgene's case, we made this money. Celgene's in good shape. It's January spread. So we're probably going to let it keep going. But it's already up about almost $3,000, so it's up nicely. SCO is a short that we just put on, right? And that's actually down at the moment. So, we have these different plays that we're trying to make money on, but they don't have to be bearish or bullish. It's just they're whatever they are that we think is going to be a good short-term opportunity to generate some cash, because our expectation is that all these short plays are going to lose money. All the hedges are supposed to lose money. If the long-term portfolio is making $100,000 in a month, it's pretty shocking if the short-term portfolio doesn't lose anything. And it did. All the hedges lost their assets, but it was made up for. It was offset by the gains we made in our short-term plays. So we're hedging the hedges, but not really. I don't want to say it's hedging, because we're not specifically playing longs to offset. The short puts are, of course, longs to offset. Those are specific. If the market keeps going up, these guys should all do pretty good, right? They're not all doing good. ABX is sucking wind. But, Apple, Disney, IBM, it'd be very, very odd for those things not to make money if the whole market is going up. And if the whole market is going up, then these indexes are going the other way on us. And these do not reflect the adjustments that we called for the other day. And then the butterfly portfolio could care less what the market's doing. It's going to just grind out its little gains. And the money talk portfolio, we never trade other than when we're on the show. It's also just grinding out its little gains. And the options opportunity portfolio, let's see how they're doing. 15%, what the frick? I don't know why. For some reason, it lost like 10% really fast. I don't know what happened to it. I have to look at that and figure it out. I don't see anything that's particularly. Sometimes things go zero for no reason, so I have to look at that. But I don't see anything here that seems wrong as far as pricing. I don't know which particular play would have hit us like that. This one, Helios and Matheson, is down to 2 cents at the moment. But we don't have much left to lose on those guys, so we'll see what happens. But anyway, we have our hedges. That's what I really want to talk about, the short-term portfolio. We have these hedges. We just added some more hedges, which I talked about this morning. We amended the hedges. So these are what we had. And then what I added Wednesday. So this was Monday, and I did a quick short-term portfolio review, and we got more aggressive on DXD. We got more aggressive on SCO. We actually changed that play. We have the SQQs here and TZA. So we actually pressed all the hedges, and we added, well, we didn't add, but we have now $200,000 worth of protection in the short-term portfolio, and we also have 163,000, which I don't think that changed in cash. Where is that? Yeah, right there. That didn't change. We didn't do anything yet. So you have $163,000 in cash. Cash protects your portfolio too, but only if you're an actual investor. If you're a trader, cash doesn't protect your portfolio. But if you're an investor, it does. And here's the logic for that. I'm going to own Apple whenever I can when it's cheap. So if I have an Apple position now, which here is a 2020 165, 185, it's a proxy. It's not owning Apple. It's a proxy for owning Apple, but it's $13,000 on a $20,000 spread. No, I'm sorry, wait, 165. Oh, I'm sorry, it's weird by the years. I think we adjusted this one. This is 2020, so that's why it doesn't work out the way you think it would. Anyway, I own Apple. My ownership is a proxy in the June 2020. If Apple gets lower, I'm still going to own Apple. If it gets lower than that, I'm still going to own Apple. That's where, when I say your cash is a hedge, comes into play. I will use more of my cash to own more Apple at a cheaper price. So even though this position may lose money, I will get a bigger, longer position on Apple if it goes down. That's what you do with the cash, is you go shopping. And what I talked about this morning in the post is because we had hedges like that, and because when the market collapsed, we got the 200,000 from this and the money from that, and we had the short positions. Because we were hedged, we didn't go to zero. Our trading accounts, I'm sure you know people whose trading accounts were wiped out or got hit so hard that they just sat there saying, I pray to God it comes back. Because there was nothing they could do about it other than hope it comes back. They had no cash, no nothing to do something with. In our case, if our positions get knocked down 50%, we've got more than 50% of our money in cash. So we can double down on our positions as they go to ridiculously low prices. And that's what this was all about. Back in, I don't know if this is what day exactly, March 4th, March, whatever it was, March, it was somewhere around March 6th of, I think it was Friday, March 6th, and March 9th was the real bottom. I wasn't on TV March 9th, I was on TV March 6th. So March 6th of 2009, I was doing this show. It was a 3-hour show. I was there's a show, there was a show. It's not even, you can't even go to the link anymore. If you go to this link, I think it's dead. There was a show called Livestock with Tim Sykes. He's like he's a penny trading guy. For whatever reason, he asked me to be his guest on the show to do a 3-hour thing, which I was like, wow. I said, but I said at the time, I was like, hey, that'd be kind of fun actually. I'll do your show. So I was going to be his whole guest for his whole show. He usually has like a few guests. Oh, I'm sorry. No, it wasn't supposed to be 3 hours. That's right. It's not a 3-hour show. I don't know what like the time of the show is. The thing is, we never stopped the show. Usually his show ends, but because the market was so insane, we just kept going. And so it turned into a 3-hour show. It wasn't supposed to be a 3-hour show. It was supposed to be maybe an hour or whatever. But I was supposed to be his only guest, and we just never went off. He cleared it with the studio, and they just kept going. But anyway, so I'm on TV, and the market is completely collapsing. But meanwhile, at PSW, we had our hedges, and our hedges were making incredible amounts of money. We had, we had the FAZ, we had the ultra short financials that made, I think we had like a $20,000 position that made $150,000 when the financials collapsed, crap like that. So we had all this cash sitting around while the market was collapsing. So I'm like, okay, now we've got to buy. And now we didn't know it was the bottom because that particular day, the market dropped I think it was like 1,000 points. It was like that day, the market just completely collapsed. And it continued to the Monday. It wasn't like I called the dead bottom. I just said, look, these prices are ridiculous. And the prices were, and I don't know if I have that somewhere. I think I have it somewhere. There. The prices we were going in on were AIG 40 cents, Bank of America $4, Cypress Semiconductors $5, Ford $1.68, FAS, the financial long $4.76, GE $8. Wow, it doesn't even seem like a good deal. It's like so what? They're close to 8 now. Google $3.50, not $13.50, $3.50. HCBK, they got bought out. $9.50, Hovnadian 80 cents, International Paper $5.62, The Russell 37, JP Morgan 1680, United Health $20, VNO the REIT $30, Wells Fargo 12, US Steel 10. I mean, you guys know me. I was trying at these prices. I'm like, how do you not buy these companies? The world has to stop. The world has to end for all these companies to go to zero. We would have to just simply stop waking. And I don't mean end like financially end. I don't mean end like lots of people are out of work or the Great Depression end. I mean end. Because even in the Great Depression, they were still an economy. Somebody was still making money. Somebody was still selling food to somebody. Somebody was still putting clothes on people's backs. Not nobody made money. Somebody made money. Rockefeller made a fortune in the Great Depression. JP Morgan made a fortune in the Great Depression because they had money when nobody else did. So they were able to say, okay, so what is working? Let's buy that. So while I'm on TV on this show, I said, look, and I was being careful. I said, look, the financials. Let's go long the financials. This is overdone. Made 1,100%. And this is, by the way, in 6 months. This is how much they turned around. Again, financials, 455%. I advocate 1,000 shares. 1,000 shares at 14 went to 77.50. That's $60,000 on that trade. Put in 14,000, get back $77,000. FAS again. Long on the Russell. Long on GE. So you're just talking about the Russell, right? That's when I'll buy the Russell. When it's at freaking 390, I'll buy plenty of it. GE. And most of the trades I was making, they were $1,000. I was trying to pick like $1,000 and $1,000, so everything would be $1,000. So that was the point of this. And that $1,000 turned into $13,000 invested on 13 trades, went to $61,000. That's how you get your portfolio back. These aren't stupid risks. We went long on GE. Well, it sounds stupid now, GE. Bank of America, Disney, Amazon. Oh my God, I actually was long on Amazon. Isn't that weird? Target, Hovnanian, RKH. I mean, it's just these are basic things to buy. But they were super cheap on sale, so we bought them. But you can only do that if you have cash when the market crashes. If the market crashes and you're stuck because you're already heavily invested in Disney, or if you're stuck because you're already heavily invested in Amazon, no matter how good you think they are, no matter how great you think they're going to grow, if the market falls, God forbid, if a nuclear bomb goes off in Manhattan tomorrow, it'd be just like 9/11. The market would be closed for days. They'd probably open down, even if you pretend there's brakes on them and say it's only going to open down 10%, that would be the opening bid that would last for a second. They'd go down 20, 30% in a day. There's nothing you can do about it if you're not hedged. And if you have options like we do, where you have short calls, you can be in big trouble. Short puts, I mean, you can be in big trouble if you get losses like that. They'll mount up really quickly. So the hedges, especially if you're selling puts, are super critical. And again, this is for catastrophic insurance purposes, but you never know. This is the kind of crazy world we live in. You know, I remember on 9/11, I had a company, it was a data company, and I don't want to say anything was good about it, but I mean, we were down like everybody else. You know, when it happened, everything went down because the World Trade Center was also where all the communications lines went for the East Coast. Except We were back up in an hour, and we provided critical data to the real estate companies. They weren't up, but we were up. It took 3-4 days for our customers to be up. But when they came back up and they called us, we were the only company in our business in New Jersey or New York that still had data for people. And so anybody who wanted to try to get back to doing business for the next week or so, we could do it, nobody else could, because I'm so crazy that I made sure we had 2 T1 lines. One T1 went to the World Trade Center like everyone else's did, but I spent a lot of time and effort to find the T1 that went west instead of east. So our other T1 line went the other way and went out to through Philadelphia. And it didn't go to New York at all, because I had said before 9/11, I say, because this is the way I think, I'm a hedger. And before 9/11, I said, well, we need to back up T1 line. I said, well, what's the point of having a backup T1 line if it goes to the same place the other T1 line goes? Then it's not really a backup. It's just another T1 line. I say, I'm worried about a natural catastrophe that knocks out the T1 lines. I didn't know what it was going to be. But I said the point of this, having another T1 line, is something bad can happen to the first one. And I said, if something bad happens to it, what's the difference if they're all coming from the same place? You know, and because of that, I mean, it worked out well for us because we picked up a lot of clients because we were the only people who had business who were able to do the work. It's just a matter of being prepared, though, and it's the same thing with the stocks. Okay, I mean, I don't want to be jackalish about it, but the reality is, it's like, well, you know, why be an idiot? What the hell is that? Oh, I see. I muted my phone, but my iPad's in the room and picking up the phone. Not now, mother. It's my mommy. Anyway, so hedging is like that, though. It's like, you know, you don't know why the market's going to crash. You don't know what's going to happen, and hopefully nothing does happen. But God forbid something happens, you don't want to be the victim. You know, be the asshole that's able to run in and buy all this stuff. You know, we were having, you know, we were there having the best time while the market was crashing. And it was me and Tim were on the TV, but I was doing a chat room, not actually the same as we do now in the member chat. I was doing a member chat room, which was up. This was 2009. This wasn't 9/11. This was just the market crash. So we had the chat room running, and everybody on PSW, we were well hedged, and people were saying, well, what can I buy? What is there? So we were coming up with trade after trade after trade. Now, Tim's guys, who he was chatting with, were getting wiped out because they didn't have hedges. They couldn't trade. They were just freaking out at how much money they were losing. Our guys were like, holy shit, this is fantastic. My portfolio is only down 5% and stocks are down 50%. You know, not today, but just from the beginning, where people are like saying, I'm fine, I'm hedged, I got money. What do we do with it? And, you know, yeah, it was 10 years ago. But the time before that was 10 years before that. And the time before that was the S&L crisis in '87. That was 13 years before that. And the time before that was Nixon, or I think there might have been something in between, but there was another, you know, the whatever. Nixon, well, Watergate was 40% also. We lost 40% during Watergate. That was 72, so it's 15 years, and I think there was something in between. It doesn't never happen. It happens all the freaking time. And you never know when it's going to happen. And especially when you are in a crazy bubble market like this, where some freaking moron can write 2 paragraphs and ascribe $500 billion of value to 2 companies. Just because he felt like it today. Well, not because he felt like it, but because somebody told him, hey, see what you can do to goose the NASDAQ. You know it's bullshit. But tomorrow it can be a JP Morgan guy doing the same thing, and a Citibank guy will do. That's what they do. They you know, the one guy does it, then another guy does it, and people keep upgrading and raising their targets. And before you know it, the whole index is up 20%. That's how you get, you know, that's how you get the tulip mania. That's how you get this with the NASDAQ. Here's 2000 at the beginning of 99. 3,500, more than 3,500, 75%. That year, 75%, really like 100% basically in that year. Then it goes up again. Doesn't seem that bad when you go 35 to almost 5,000, another 1,500. That's what, 40% more. But you know, after 100% year, you're like, wow, we should do this all the time. But most of it came in one huge surge right here, 2,500 to 5, almost 100% surge in a few months. After you had a big rally that you say, oh my God, I can't possibly go any higher than this. And people shorted and people shorted and they went broke shorting and it went up again. They thought they were going to make money here. Then it goes flying up again. And by then there's nobody left to short. None of the shorts had any money. And then it all collapsed. And like I was saying, all I did was at this point here, I don't even say that. I would say somewhere around here, I stopped playing. We were up so when it got to 3,000, got to 3,000, I said I was completely out and I was just negative all the time. When it was down here, I was I was barely playing like I am now. In fact, frankly, when we were down here, this is how I was with the NASDAQ. I was mostly in cash. I was very careful about the plays. I made plenty of money, but not the kind of insane money where like I had friends who like made $100,000 in a month. You know, just like trading a little bit, just boom, $100,000 a month. They're like, yeah, we're gonna do this all the time. I'm like, no, you're not. And then some of them held on to it because they used the money to buy stuff. But you know, the guys who made $100,000 went out and bought a Jaguar were better off than the people who made $100,000 and kept playing. You know, but that's just the way it was. But it's amazing because most people just kept putting more and more money in. They let the money they had in their ride. And then it just exploded. And was I wrong to say things aren't worth this much money? When they became worth that much money, they weren't ever worth that much. It's very clear from here out. They were never worth this much. But it doesn't feel that way while it's happening. It doesn't feel that way today when the NASDAQ is up 100 more points. That's crazier than it was then. 100 more points a day. And how many days? We don't even think about it much when the NASDAQ goes up 100 points in a day. This whole run from 2,000 to 3,000, that's only 1,000 points, and it took them a year. We're up 100 today, and it's not like we're up 100 on some huge scale. The NASDAQ's at 8,000. It's not even double where it was. These are huge moves that we act like it's nothing. But where is this fantasy money coming from? Where is it ever going to get supported? What happens if they try to sell these stocks? The same exact thing. When people change their mind and turn from buyers to sellers, it goes down as fast as it went up. Can't help it because it was all bullshit in the first place. So keep that in mind. Make sure you have your hedges. Look at the portfolio reviews. Look at what we're doing for hedging, and keep a clear head. We're going to do more reviews and do more hedges as things go on. We have enough hedges in the short term. We're now buying long term. Now I got to look at the options opportunity portfolio and figure out what's wrong with that. And we'll have to look at our hedging strategy there. Obviously, I guess either we're too short or we sold too many short calls. Something I don't know. I have to figure out what's going on there. So that's my next thing. So I'm going to have to review that portfolio again. All right, last questions and I'm out of here. Nope, there are no other questions. Okay, great. That's it. And I'll see. I won't see you next week. I happen to have a meeting on Wednesday of next week. I won't even be here. I'll be in New York. I'm in Florida right now. I'll be in New York for a couple of weeks. But I think I'm, all right, we'll see. Definitely not next week. No webinar next week, and maybe the week after that. I'm not sure. I have to figure this out. All right, so I know both weeks are bad, but next week is definitely off completely. All right, so I won't see you next week. Have a fantastic holiday weekend. We'll see how we do with that oil short. Will you be in the chat room? Oh yeah. I'm not gonna be gone. I just, I mean, Wednesday. I will leave early on Wednesday next week because I have a big meeting with the. Oh, I know what it is. It's 2 PSW projects. Next weekend on Wednesday, we're launching the Judgment Search Network, so that's a big deal. And I couldn't get out of them. I tried not to make it Wednesday, but it was just ended up being Wednesday. Nobody else could get it to work. And the week after that, I have a meeting with the pot company where we're doing a strategy meeting in New York and we have 2 days of meetings there. So that's why it's bad. So probably no meeting, probably no webinar for 2 weeks. But I'll see if we can figure out a time. Anyway, so I'm going to be doing a lot of business meetings, but I will be in the chat room. It's just that I've got a couple of times I'm going to have to be out for a day or half a day or whatever it will be. All right. Thanks, everybody. Have a lovely day, and I'll speak to you later. Take care. And watch those gasoline ones. That's a big opportunity.